Today, on You're Buying a Home with Silas Lindenstein, we're talking about the 50-year mortgage. Is this a good idea?
You're buying a home. You're buying a home with Silas Lindenstein. Pull up a chair, we'll walk the line. Big step, big dream.
Hello, everybody, and welcome to You're Buying a Home with Silas Lindenstein. I am your host, Silas Lindenstein. Welcome. Today, I am talking about the 50-year mortgage. We're going to talk about whether it's a good or bad idea. It was something that got out there in the news. People started talking about being put out as something to make homes more affordable. And for a while there, it was like the question I was getting asked by a lot of people, would this really work for me? And so I have been wanting to do an episode on it and break it all down for you. And we got to that here today. So that's what this episode's going to be about. And we're going to, a lot of things to consider on any mortgage you pick. I'm gonna be discussing those today. For those of you new to the program, my name is Silas Lindenstein. I am a real estate agent in the Seattle, Washington area, but it's okay if you're not from Seattle. This podcast is still for you. It's about educating and empowering home buyers all over the nation. So we're going to get into that in a minute. If you're new to the program and you want the step-by-step how to buy a home, that's the first 10 episodes. Just go back to the episode number 1, listen to 1 through 10. You got exactly what you need to buy a home. I also have an ebook form. You can email me at silas@silasgetsreal.com and I'll send that out to you. Anyway, so that's what we'll do. And of course, if you have an agent, if you want an agent in your area, I have a network of agents all over the country that I can connect you with. Just again, email me at silas@silasgetsreal.com and I will help connect you to a wonderful person. I promise. Right? Okay. The 50-year mortgage. It's funny. People wonder, like, is this possible? This is going to help my home. Most mortgages, well, maybe you don't know. Most mortgages are 30-year loans. That's the common one. That's what's become the default for most people. You also have your option for 15-year mortgages. Sometimes people want to pay it off really quick. That you also get a little bit shaved off the interest rate for doing that. And some people really love that. They're going to be paying less for their home overall, and it'll be done quicker. That's an option. There's even a 40-year mortgage. There's a lot of programs that offer 40-year mortgages right now. I know someone who has it, and I think they told me it was a little bit out of desperation because it did lower their payment, but it made everything work. And now we got this 50-year. So it's not actually as crazy of an idea as initially people thought, because they just heard of 30-year mortgages, because there are 40, but most people don't choose those. It's just not something that seems like a good idea. And let's break down why. I want to talk first about monthly payment versus total cost, the illusion of affordability. So by spreading your mortgage out, you lower the payment. Every time you spread it out to a longer length, you lower the payment. So a 30-year mortgage is cheaper than the 15-year per month. And the 40 would be lower than the 30, and then the 50, of course, over another 10 years would do that more. However, factors to consider is not only is the length of time increasing that you are borrowing money, that means you are giving more in interest money to the mortgage company. Another 10 years worth of mortgage. And when you are charged every year on how much you owe, you need to realize that in the beginning of your mortgage, you are constantly just paying the interest. They take the amount, they figure out in the very beginning, how much interest are you going to pay over 30 years, 40 years, 50 years? And they go, okay, well, you're going to pay that first. So it's called amortization. And it's not all, your mortgage isn't usually interest only to begin with, but it's like, if you're spending $2,000 on your mortgage, like $1,800 of that is going toward interest on the very first payment. The next payment, $1,799 are toward interest, and $2 are toward the principal. So they very slowly lower it. But when you're looking at the end of the year, what they're charging on the interest is going to be you're paying that interest first. And so you're not they've calculated all the way out to the 40 years. So they're making sure that you're paying interest first. So you're not lowering your interest very much. You're also we talk about building equity. That's the money you owe. The equity is the money that you have in the house that you don't owe. It's the opposite of what I said in the beginning. So let's say it was a $500,000 mortgage, right? $500,000, and you've paid off in whatever way. You paid off $200,000 of that, both in payments, your down payment, or whatever. So you have $200,000 in equity in this house that's worth $500,000, and you owe $300,000, right? Now, of course, your house could be going up in value. So your house, when you bought it for $500 and $200,000 of equity, now your house is worth $600,000. So your equity has gone up. So you only owe $300,000, but your home is worth $600,000. So you have $300 of equity in it. That's what equity is. Because it takes longer to pay off actual principal, you're not getting much equity in the house early on. One of the advantages of the 15-year mortgage is you are paying so much more quickly that you are getting into the principal payments right away, the principal, the amount you actually owe, that you build equity really quick, which people will use to get home equity loans for repairs or to fix up the house a little bit. That could be a whole nother episode on should you touch your equity or not. Generally, if you could just not and just pay down your house, that would be the best thing. So anyway, this 50-year mortgage gives you this illusion that because what would have been a $3,000 mortgage is now only a $3,000 mortgage is now a $2,800 mortgage. It took $200 off your mortgage. And when you're first qualifying, $200 is really, really important. But that doesn't mean the house is cheaper. In fact, you're spending extra hundreds of thousands of dollars for a home potentially. Look at my own house I got bought it at $500,000, right? In a 30-year mortgage, by the time I paid it off, I believe it's about $1 million that I will have spent on the loan over 30 years. So not at once. I don't have that kind of money. So now, if I extend that another 10 years, I'm guessing it would be another $200,000 that I probably will spend over that time on just interest. So it's not a cheaper house. It actually costs you more in the beginning. What it does is it benefits you in the short term for cash flow. When you need the cash is usually right away. So you get that little break, but you're not doing the wealth that you would expect. You're not long term. You've paid far more than hopefully you should have. Lenders tend to sell what is affordable, not what is sustainable. Need to remember that. Lenders, as much as I like the lenders I work with, they do good things. They help get you loans that you need for the house, and they're good people. But a lot of them just sell, the company sells their loan off later on, so it's someone else's issue. They just need to know that you're qualified now, but they're not always looking about, well, what happens in 15 years? What's your life going to look like then? I worry about the 40-year mortgage just being sustainable. Okay. The other thing that you have to realize is interest rates go up the longer the loan is, because they're taking a risk for longer, theoretically. Theoretically, it's a longer risk of a loan. So you're going to see something go up we could say half a point, like a 0.5% interest rate increase which is substantial. Like, people refinance their whole home if interest rates are even changed less than 0.5%. They'll refinance it because it's going to save them thousands of dollars. So a 0.5% interest rate is huge on a home. And it could even be more than that, the interest change. So you're paying much more interest. And that's part of why you're paying much more interest too, is longer time, higher interest rate. The quicker you can get your loan paid off, that your agreement is, that 15-year, they love that. So they'll give you the lowest interest rate possible for doing that. Okay. You're going to, because of the compound interest, you've heard people talking about this with their home loans lately, because the interest rates are so high now than when I was a youngster, how it feels like they barely touched their, how much they owe, like paid for 12 years and barely touched the principal. That's how it's going to feel on this. Who are the products? These products, that's what I call them. A loan is a product. Different types of loans, FHA loans, conventional portfolio loans, which I don't think we've talked about a lot on here, but this product, who's it for? Is a 40 to 50 year mortgage meant for a first time home buyer or an investor? An investor is not going to do that. I'll tell you that, because they're too good with numbers, so they won't do it. Is it temporary? Now that's a thing. If for some reason you knew that temporarily you could do this because you will refinance later, that might be a reason. Like, but you have to know. Like, let's say you can't qualify on your own, but let's say that you have a spouse, a partner, somebody you're buying the house with, and say they're in school right now and you're able to, they're letting you buy the house because of your wages. You know that you'll be able to refinance once they get a job, once they're out of school, they're making the big banks, the big monies, the cheeses. Then that might be a time that it would do, if you just need that little gap just to get you there. And I want you to understand the difference between something being available to you and advisable. There's a lender I use named Karen Sibley. I use her a lot because she really understands this. She tries to advise people on the best products for them, not with just possible, because just possible there's some horrible loans out there that are possible for you to get, but you shouldn't. Some are so bad it'd be that us as people who sell real estate and want you to buy, we would rather you not buy a house than to get these products. An interest only mortgage loan, that's nuts. I wouldn't do that to you. An 8% interest rate, no, we're not. Try not to do that. There's like a psychology of mortgages of so the people who choose 15-year mortgages, for example, people want certainty. They want this emotional relief, and they want a finish line. And when your mortgage is only 15 years, you can see the finish line. 30 years, it's hard to see that. Because you're not close, right? But 15 years, I have a kid in college now. That's in her life. That would be my mortgage would be done. That would have been amazing. But I couldn't afford it. It was way too high. You're paying each month. But that emotional relief of seeing the price, the amount you owe go down each month is huge for them. I mean, I get excited about the 5th year into my house. And about 5th year, that's when you really start feeling like you're hitting that principal. You're like, yeah, you want that. Now, flexibility wise, the problem with a 15-year mortgage is you have to pay that much each month. And where, let's say you had a $3,000 mortgage, right? You owe that every single month. If you were to do a 30-year mortgage, you would only have to pay $2,500 a month. And that may not sound like a lot, but it is. That extra $500 can be huge. Some people will suggest do the 30-year mortgage and then pay it like a 15-year mortgage. Pay it while your income's high, while you've got a good, solid job, so that if you did get laid off at some point and you have times that that you can sit around, that you will be sitting around, not your choice, that you don't have to come up with as much money each month as you're used to. It's kind of like how I've suggested you should spend a few months before you buy a house living like you have a mortgage and just save that money and put it away as a down payment so that you're used to it. If you're used to spending that extra $500 a month and suddenly you get a break on it, it feels really good. And it could be more than that. It could be like $1,000. Sometimes I regret, like, I got into my house at a really high interest rate, the one I'm in now, just because of some life things. But when we refinanced it, it dropped my monthly payment $1,000, and that was such a relief. $1,000 a month. A couple people doing well in Seattle. But if I had just kept paying like I still owed that extra $1,000, I would have really been hitting away at my how much I owed on the house, and that could have been wonderful. So it gives you a lot of options there. That's why some people will just keep. They used to, before the disaster of super low interest rates, people would refinance their house a lot to help lower their payment, to bring it as low as possible. It's a strategy that doesn't really work anymore. Well, not with the people that are stuck in homes with a 2% interest rate. So mortgage terms, you could say, are less about math and more about how people sleep at night. What keeps them up? The flexibility, the mortgage. I want you to be careful though of the refinance trap. Too often, you'll have lenders or whatnot saying, "Hey, don't worry about it. You can just refinance later." But love the house, date the mortgage. There's a bunch of people that were doing that last year. Right when the interest rates started going up a little bit, people were like, "Don't worry, you can refinance later." Agents, real estate agents, and lenders telling people that. I'm like, that is dangerous. What if it doesn't go down? And it hasn't. They haven't really gone down very much. They just kept going up. Now they're going down a little, but not. So some people who were dating the rate, they ended up married to that date. It was like a unexpected pregnancy, and now they're stuck. They're stuck there. It's really dangerous because you might not be able to refinance later. So, and dangerous might be low. It's cautious. Be very cautious. A lot of people do it. A lot of people buy it and then refinance later. That does happen a lot, but you can't guarantee it. Nobody has a crystal ball. So I would just hate for you to get a 40-year mortgage and then you're, "Oh, I'm going to change it. I'm going to just refinance later." And then you can't at all. And you're stuck there with that 40-year mortgage. But again, you can pay that. You can pay it like a 30. Just keep paying extra. Try to knock it down until you can at some point. Also, there is something to be said. I don't want to be so negative on it because there are some good opportunities. The pro long-term mortgage people will say, "Well, you got to think about inflation and wage growth." Wage growth. That word makes me laugh now. But ideally, in an ideal world, you're going to start making more money as you get older, right? You make more money. Inflation goes up. So with inflation going up, your mortgage was at a certain price. You're making more money just because you make everything pays more now than when you got your house. So there's a theory that if you do get into the house at all costs because inflation happens. So then you're still paying on those dollars, because otherwise you're going to be paying on the dollars of, in 5 years. So there's some smartness to it. I mean, 30 years ago, how much people made if they bought a house now and they had a 40-year mortgage and they're still paying on it, or they're still paying on that, but now they have current wages. They qualified when they only made they made $7.85 an hour, and now they make $27 an hour. So they're probably in a good financial position, right? What I want you to understand is that homeownership is not a single decision. It's not just about this mortgage rate, right? It's about buying the house is your first decision. Mortgage choice is number 2. You don't want to lock yourself into stress unnecessarily. And I just realized as I've been talking, I even kept saying 40-year mortgage because that exists. 50 don't really exist yet. They probably will. Someone's probably taken that idea now and it's like, yeah, we're going to build out a package for that. So now here's a 50-year mortgage. If that comes to be, just be very careful. Okay? Just promise me that. Be very careful. Try to see if you can afford a 30-year mortgage. That's your number one thing to start off with. See if you can afford that. Then try to live with that a little bit. You don't want to look at a 40-year unless it's absolute, the only way. 50 years, even more. My God. I just can't imagine. Partly because I'm at an age where 50-year mortgage sounds way more optimistic than I am I'd have 50 working years. Well, actually, I don't know if that's optimistic or sounds like a horror movie. Work for 50 more years. My gosh. All right. But folks, that's it. That's what I wanted to talk about. Appreciate you for listening as always. Please, if you like this podcast, please go to your favorite platform, Apple Podcasts, Spotify, and give me a 5-star review. If you want to give me a 3-star review, just stay away. Just go watch TV. But if you're a 5-star review person, please go review. And also, again, if you want to get my physical book, it's an ebook. It's not a physical book. Sorry. If you want to get the ebook, Silas at silasgetsreal.com. Or if you need an agent, let me know. I got one in your area. I'm sure I do. I will connect you with a great person to help you buy a home and to guide you. Even if you're a couple years away, start that relationship now. Just do it. Okay. So until next time, my name is Silas Lindenstein with Boutique Brokerage here in Seattle, Washington. And thank you for listening and happy home.
You're buying a home. You're buying a home with Silas Lindenstein. Pull up a chair, we'll walk the line. Big step, big dream, but the jargon feels mean. Pre-approval inspections, what's it all even mean? Hit play, slow it down, from that rent to your own ground. Every episode, another brick, another sound. You're buying a home.